Once you understand how the market works, it's amazing how much wealth you can build. So today, we're gonna talk about 10 lessons for stock market investors. The first one is sometimes it's best to buy a stock going up. I have lost so much money just waiting for a stock to come back down instead of just buying a great company on the way up. An example of this would be I waited for Netflix at $150 to come back and retract, where I have lost thousands and thousands and thousands of dollars if I would have just invested that money instead. So sometimes it's best to not wait for a dip and actually invest in companies that are going up over time and allow your money to get to work and get in on those gains. If it's a great company, it's going to keep going up. Number two, don't be in a rush to sell. One of the worst things that you can do is sell a great company, because over time, great companies go in one direction, and that's up. And some of my biggest mistakes have been selling companies too early. So if you choose a company, have the mindset that you want to stay with that company for at least 10 years, unless something crazy happens to their financials or something along those lines. Number three, fear and emotions are the enemy of investing. Scared money don't make no money. Listen, emotions can kill you when it comes to investing. When the market goes down and your heart flutters and you get emotional and you start selling your stocks instead of looking at this rationally and seeing, why is this going down? Is this just an emotional wave that investors are riding at the time? Is there some political thing that's happening that's very temporary? You have to look at everything rationally when you're investing your money. The same goes for being scared to invest your money. I've had so many people, beginner investors, who have started investing their money and it goes down 1% to 2% and they start to freak out and panic. Understanding that investing over time, the market goes in one direction. Since 1929, the S&P 500 has returned 10% to its investors. So understanding that over time, the market's going to ebb and flow day to day, but over time it goes in one direction. That's extremely important to understand to reduce your emotions day to day. And if you're prone to emotions as an investor, just don't look at your investments every single day. Look at them every quarter or every year so that you don't have those fluctuations stress you out or bring anxiety. Along those same lines comes number four. Stocks go in one direction over time. So we just talked about it, that the S&P 500 has returned 10% to investors since 1929. But let me prove that to you. Pull out your phone and pull out the stock market app of your choice. Now, put the maximum amount of years that stock market app allows you to look at. And look at the total market. You can look at the S&P 500. You can look at the NASDAQ, whatever you want to look at. So maybe it's 10, 20, 30, 40, 50 years. And turn your phone sideways. What direction does that market go? It goes up. Now, what you're going to see is it ebbs and flows day in and day out. But over time, the market goes in one direction. And remembering this eliminates bad decisions, an extremely important thing to understand. So every time you're stressed out or you're worried about which direction the market is going to go, do this exercise and say, hey, the market goes in one direction over time. Specifically, if you're buying something like an index fund or something along those lines, you know that your money is going in the same direction as that market. Number five, timing the market is for suckers. So if you think that you can time the stock market, then you know the future. Do you have a crystal ball? Because I don't have a crystal ball. I can't time the market. And one of the best investors of all time, Peter Lynch, said, more people have lost money waiting for corrections or anticipating corrections than in actual corrections. And what he means by this is waiting around for corrections to utilize and start investing your money is one of the worst things that you can do. Instead, you should be allocating money into the market every single month and allocating cash from every single paycheck so that you can start building wealth over time. Number six, in the short run, the market is a voting machine. In the long run, the market is a weighing machine. This is a famous quote from Warren Buffett. And what he means by this is in the short run, the market is a voting machine, meaning that in the short run, so many investors go with the ebbs and flows of the market. It's just people putting their votes in, putting their bets in the short run. But in the long run, the market is an indicator of good businesses. And that is what is so incredibly important, because in the long run, the market goes in one direction. The good businesses thrive. The businesses with good cash flow, businesses with great financial reports, those businesses thrive over time. Day to day, it's just people voting, putting their dollars down, trying to figure out where the market's going to go. But over the long run, if you're a long run investor like I am, I'm in this thing for life. And if you're in this thing for life, then you know in the long run, it's an indicator of good business. Number 7, when the market is down or there's a recession, guess what? Stocks are on sale. So understanding the concept of buy low, sell high is extremely important. This is why it is so important to eliminate your emotions, because what you want to do when you're investing is buy low, sell high. So when a recession hits and stocks start to go down and take a dip, that's when stocks are on sale, because people are utilizing their emotion and selling stocks based on short-term factors instead of looking at the long run to see which direction stocks are going to go. So understanding that when there's a dip or a correction, that means that stocks are on sale, and it's a great time to buy. If you look at some of the best investors of all time, they all have cash on hand and they start investing their money in massive amounts when the market goes down. Now, for the average investor, I think they should be dollar cost averaging, investing their dollars every single month instead of trying to time the market and wait for the market to go down. But when the market is down and if you have some extra cash to allocate, it's a great time to buy. Number 8. Nobody knows anything about the future. So if you turn on something like CNBC or you turn on the news, all day long they're saying stocks are going to go up all day long. They're going to go down all day long. They're trying to predict the future all the time. But guess what? Like we just talked about, they don't have a crystal ball. I don't have a crystal ball. You don't have a crystal ball. Nobody knows what's actually going to happen in the market. So listening to people who say they know what is going to happen is a fool's errand. Instead, invest consistently in good companies over time and watch your money grow. Number 9, beating the market is not the goal. As it turns out, you can actually be lazy and rich at the same time. So many investors try to beat the market. That's their goal, is try to beat the market. But instead, if you become the market and you invest your money in an index fund, you're going to get a 10% return. With a 10% rate of return over time, just a few $100s a month will make you a millionaire. In fact, most professional money managers, their goal is also obviously to beat the market. And each year in and year out, 90% of professional money managers fail to do this. So what makes you think that you can do it if 90% of money managers fail to beat the market? And of those 10% that beat the market every year, they're never the same year in and year out. It's never consistent. They can never do it over a long period of time. So this is why one of my favorite ways to invest is in an index fund, because you become the market instead of trying to beat the market. And then number 10, understanding that stocks have an underlying value. So a lot of people, when they first start investing, they just see stocks as something you could throw money into and you're betting and doing all these things. But stocks are real companies. And when you're buying a stock, you're an owner in these companies. It's extremely important to understand this. And all stocks have a true underlying value. This is how Warren Buffett made the majority of his money, because he knew how to find out what a stock's underlying value is. So understanding these are real companies, that you can look at their financial reports, see how they're doing over time, is extremely beneficial for you, because that allows you to know when to buy, to sell, all of these other things. Listen, I hope you guys enjoyed this video. If you have any questions, leave them down in the comments below. And what other tips do you have for stock market investors? Don't forget to throw those in the comments as well. If you like this video, I got a couple more videos here that I know you're going to love. And don't forget to like, subscribe, hit that notification bell as well. And we'll see you on the next video.